So the rise and effects of the shadow banking system. The banks we have been discussing so far were commercial banks, whose primary role is to accept the funds from depositors and make loans to borrowers. In the last 20 years, two important developments have occurred in the financial system. One, banks have begun to resell many of their loans rather than keep them until they're paid off. Two, financial firms other than commercial banks have become a source of credit to businesses. Securitization comes to banking. So a security is a financial asset, such as a stock or a bond, that can be bought and sold in a financial market. Traditionally, when a bank made a loan, like a residential mortgage, it would keep the loan and collect the payments until the loan was paid off. In the 1970s, secondary markets developed for securitized loans, allowing them to be traded much like stocks and bonds. We would refer to these mortgages, these residential, as mortgage-backed securities. So the securitization process is the process of transforming loans or other financial assets into securities. So let's cover it. So we have financial institutions, the banks, lend out money to the households for a mortgage. The bank, the financial institution, then bundles all of these loans, and step 3, sells it to investors as a new security. The next thing that happens is the households start making payments. They make payments to the financial institution or the commercial bank, but that bank just collects a fee and passes on the difference to investors who own the mortgage-backed securities. So the shadow banking system in the 90s and 2000s brought increasing importance of non-bank financial firms, including investment banks, which are banks that do not typically accept deposits and make loans to households. They provide investment advice and engage in creating and trading securities such as mortgage-backed securities. So Lehman Brothers went bankrupt, we'll see, and so a lot of these investment banks. So money market mutual funds are funds that sell shares to investors and use the money to buy short-term treasury bills and commercial paper. Basically, they're making loans to corporations. Short-term commercial paper is loans to corporations. Then there are hedge funds. This is funds that raise money from wealthy investors and make sophisticated, often non-standard investments. By raising funds from investors and providing them directly or indirectly to firms and households, these firms have become the quote-unquote shadow banking system. What made this shadow banking system different than commercial banks? Well, number one is these firms were less regulated by the government, including not being FDIC insured. So the investments were inherently more risky. The firms were highly leveraged, relying more on borrowed money, hence their investments had more risk of gaining or losing money. So beginning in 2007, firms in the shadow banking system were quite vulnerable to runs. In the spring of 2008, investment bank Bear Stearns avoided bankruptcy only by being purchased by JP Morgan Chase. In the fall of 2008, investment bank Lehman Brothers did declare bankruptcy after most of its clients pulled out their money. After the Lehman Brothers collapse, a panic started and many investors started withdrawing their funds. Securitization grounded to a halt. With banks unable to on-sell their loans, they stopped making as many. So basically, we're putting a freeze on the whole money supply. This resulted in a credit crunch, which significantly worsened the recession. Beginning in fall 2008, the Fed took vigorous action under the Troubled Asset Relief Program, or TARP. They, provided funds to banks in exchange for stock. This is the first time that the U.S. government has taken a stake of ownership in private companies. They offered discount loans to previously ineligible investment banks. So basically, the Fed started lending money to non-commercial banks. And then the Fed was buying commercial paper for the first time since the 1930s. This was all to increase the money supply so that the financial system wouldn't collapse as they saw it. These combined actions eventually stabilized the financial system. Economists and policymakers still debate their wisdom. Some people think it was the reason that we made it out of the recession. Some people think it worsened it. So there's all kinds of theories on this. And so just to cover how this would work, so the problem is the investors only get paid if households make payments to banks. But when people started walking away from their houses and defaulting on their mortgages in 2007-8, the financial institutions weren't collecting the fees, and then these AA bond ratings that were rated by Moody's, AAA, like high-rated bonds or securitized mortgage-backed securities, investors, they started defaulting on it. And another player, which they did not mention, but they mentioned in the book, is AIG. And AIG is an insurance company that was insuring these transactions. So you could buy an insurance policy on this transaction. So basically, there was a winner and loser in this. Somebody won if the housing bubble burst, and somebody lost if the housing bubble burst. So this is why this is such an important part of financial history. So we are not covering the quantity theory of money. So that is it for chapter 8. Chapter 25, sorry.